We have a pile of U.S. earnings coming out this week, and our guest says we've been seeing pretty decent earnings so far. Ryan Detrick joins us now, Chief Market Strategist at Carson Group. Ryan, great to see you. We're only partway through the party, but you say the earnings reports have been pretty darn good, justifying the bull market. I know the index has been wobbly over the past couple of sessions.
Well, that's right. First of all, happy Monday, everyone, and thanks for having me back. We are sort of early. I think like maybe a third of the S&P 500 has reported earnings, and there's been some high-profile winners. Meta did really well. Facebook, Meta is Facebook. Sorry, Meta did well. Microsoft, maybe not as well with their reaction, but the whole aggregate, once again, is really strong. Look at almost 12% year-over-year earnings growth right now, and it was expected to be like low fours this time about a month ago. Now, one more thing. Profit margins, according to the FactSet in the fourth quarter, are looking at an all-time record high, going back to like 2009 with FactSet data. When you have higher earnings and you have higher profit margins, Andrew, that's still a bull market in our opinion. It justifies why we're flirting with all-time highs at the time we're doing this.
What has jumped out for you with these earnings reports so far, Ryan? Of course, we're still obsessed with AI. Is any clear theme emerging there?
Well, it's been strong. I mean, you look at what the kind of the big tech names have said so far about AI. CapEx spending is not slowing down. I mean, that is something that is very true and real. Now, the one thing, if you kind of peel back the onion, there's a lot more companies to report. But the industrial group earnings right now is up like 15% year over year. It was expected to be virtually flat. All right. So industrials is that one group that's really doing well. And you and I can get in more of this. We've talked about this the last couple of months. This rotation from the Mag 7 to the 493. Industrials closed at a new monthly all-time high just last week. The equal weight S&P 500 last month in January was up 3.5%. That's a great move versus the price-weighted S&P 500 up about, I'm going to say only 1.5%. It is real that this rotation's happening, and it's being led by industrials, which to me is a good thing because that the economy's strong, industrials lead. That's probably positive.
As opposed to just being fueled by a few big tech stocks, right?
Exactly. I mean, you look at like the breakdown of the S&P 500 gains the last several years. Well, we know 2023, 2024, if you didn't have a lot of tech exposure, specifically large cap tech, you underperformed or you missed your benchmarks. Last year was the first year, again, in about 4 years, where the 493 actually added more to the overall gains. And you look again where we are now, and that's still happening. Now, I want to be very clear. This doesn't mean we don't like tech. We're more equal weight tech. I think a lot of these tech names are beaten up, maybe unjustified. They're probably going to come back. By the second half of this year, by then. But the reality is this is a global bull market. We've talked about that. There's a lot of opportunity, and it's being led by a lot of sectors, not just large cap tech, which I like.
Talk to us about this selection of Kevin Warsh as the next Fed boss. The market, apparently there are some reservations that he may be more hawkish, more inclined to keep interest rates higher than President Trump even would like.
Well, that's right. Look at something like called Fed Funds Futures, what the betting market said when this all came out. There's not like more cuts coming. There's still 2 cuts coming. Most people agree. But if you look out further, even into like 2027, he might not be as quite dovish as President Trump wants. And no one knows. I get it. It's early. But I'll just say this. He has a long history of being quite hawkish, being kind of anti the Fed in a way, bashing the Fed every year with the Wall Street Journal article, op-ed article. He became dovish in 2017 and he became dovish again recently. Now, what was he trying to do both those times? Trying to become the leader, the chairman at the Fed, and he's been hawkish other times. So listen, we'll see. But what really happened, as everyone knows, the huge drop in metals across the board on Friday with the realization that maybe he's not going to be quite as dovish longer term as President Trump wants. The dollar did jump on Friday. It's been obviously very weak, U.S. dollar has, but the reality, a lot of questions, and it was a kind of a sell first, ask questions later mentality as it pertains to metal. But let's not forget, silver is up 65% for the year. Gold was up with 25 or 26% for the year. So both of them had massive pullbacks. I mean, you could argue crashes, honestly, on Friday. And a lot of that, again, was due to the confusion, how do I put it? The uncertainty over will he be as dovish as President Trump wants? And we are skeptical he will be, Andrew.
What about gold? Maybe we can put up a 1-week chart. Do you think people were thinking, there's such momentum here, I'm just going to ride this pony?
Yes, I mean, we heard that a lot. Now, we've liked gold for a while. We added gold to our tactical models here at the Carson Group way back in March of 2023, and I just listed some numbers. I mean, it was up 25% for the year, literally like on Thursday last week. So that's a stretch rubber band, silver stretch rubber band. It could have been any particular reason to kind of have the sell off. What's the old saying? The market takes an escalator up, but an elevator down. Clearly, that's what happened in gold and silver and across the board, platinum, palladium. I mean, just pick it. It was a rough day, but I will say this much: we're still in the camp that this is more of a commodity super cycle that has likely years left to it. This would be the shortest gold bull market ever. I mean, copper just recently broke out to new highs. A lot of other these industrial metals are just breaking out to new highs. So we think it's the global economy is strong, like we think it is. We're seeing that in earnings season. The commodities and base commodities will continue to do well. They just, honest to goodness, just got ahead of themselves. When you're talking silver up almost 66% for the year, the third week of January or near the end of January, that's not anything we don't know. That rubber band was too stretched, and it was due for a violent pullback, and clearly we've seen that the last several days.
Just finally, remind us of how the January indicator works, Ryan. It often points to the performance for the year as a whole.
Yeah, it's a fun one. We call it like the January barometer. So goes January, goes the year. If January's higher, like it just was this year, the full year's, the next 11 months. The next 11 months are higher 87% of the time.
Wow.
Up like 12% average. Versus if you're down the first month, you're up like a coin flip the rest of the year, and you're up like 2 or 3%. Not much. So this is just one data piece, but just know this: in 2022, a down January had a bear market. The last 3 years, up January's pretty good market. There's a lot more to it, but I would say the January barometer is one potential positive, kind of cherry on top, if you will, along with those earnings and profit margins, which matter more, that says it's still a bull market in our view.
Ryan, we better jump. Thank you very much. Have a great February. Always great talking to you. Ryan Detrick.
Thank you. Appreciate it.
Chief Market Strategist at Carson Group.